What current events are influencing the Phillips curve? Have you ever wondered how current events shape economic theories? One theory that has been in the spotlight is the Phillips curve. This curve illustrates the relationship between inflation and unemployment. Traditionally, it suggested that lower unemployment leads to higher inflation. However, recent events have changed how we view this relationship. Since the COVID-19 pandemic began in 2020, inflation has surged significantly. Between 2021 and 2023, we saw inflation rise sharply, even with low unemployment and high job vacancies. This period challenged the old belief that the Phillips curve was relatively flat. Instead, it appears that the curve may be nonlinear. This means inflation can accelerate quickly when labor market tightness crosses a certain point, such as when job vacancies exceed unemployment. The ratio of job vacancies to unemployment has become essential for understanding inflation trends. Data from 2000 to 2023 shows that when labor markets are tight, inflation tends to rise more sharply. This suggests that the Phillips curve slope steepens under specific conditions. Policies aimed at keeping unemployment very low for extended periods could lead to faster inflation than previously expected. Monetary policy decisions also play a role in influencing the Phillips curve. The Federal Reserve's approach to managing economic growth and inflation can significantly impact this relationship. Allowing unemployment to remain very low to boost growth can lead to higher inflation in the short term. This aligns with forward-looking Phillips curve models. If businesses and consumers expect inflation to rise due to tight labor markets, inflation can indeed accelerate. Recent data indicates that the fundamental relationship described by the Phillips curve remains stable, even with fluctuations. Updated data through mid-to-zero, for supports models where inflation and labor market slack maintain a predictable relationship. This reinforces the idea that the Phillips curve is still a useful tool for understanding inflation dynamics, especially when considering the nonlinear aspects of labor market tightness. From a conservative viewpoint, these developments highlight the importance of prudent fiscal and monetary policies. Avoiding the artificial suppression of unemployment below sustainable levels is vital. Doing so risks triggering unwanted inflation. The evidence of a nonlinear Phillips curve suggests caution against prolonged stimulus or policies aimed at running the economy hot. Instead, policies that promote free market mechanisms, labor market flexibility, and controlled government spending align with managing inflation without sacrificing economic growth. In summary, current events such as the post-pandemic inflation surge, labor market tightness, and Federal Reserve policy decisions have highlighted the nonlinear nature of the Phillips curve. Understanding these factors supports conservative economic principles that favor balanced growth and caution against overly aggressive attempts to push unemployment below natural levels.